Have you ever wondered why one of the most successful investors of all time, Warren Buffett, is selling billions of dollars in stocks while everyone else is buying like we're living in the best economic moment ever? Why is he hoarding over $157 billion in cash as if he's bracing for a financial storm? Something big is coming. And while former President Donald Trump returns to the political spotlight with aggressive economic moves, Buffett quietly steps back, protects himself, and prepares. This is no coincidence. It's a silent warning only the wise are hearing. So if you've ever felt like you deserve more than what you have, type in the comments right now, "I deserve abundance," and you'll be activating a powerful affirmation. Stay with me until the end, because I'm going to reveal how you can protect your money even if you don't have millions invested. All you need is clear information, strategy, and action. Chapter 1. What is Warren Buffett seeing that we aren't? Warren Buffett is not a man who acts on impulse. Every decision he makes is backed by decades of experience, solid data, and razor-sharp intuition. And right now, while the market celebrates every upward tick, Buffett is selling. Not just a few stocks, but entire positions in companies once thought untouchable. Why? Most people see what they want to see: green numbers on the screen, promises of recovery, reassuring messages from the media. But Buffett doesn't look at the surface, he looks beneath it. He sees fragility in profit margins, signs of economic fatigue buried in financial reports, and silent patterns that always appear before every major financial collapse. And guess what? He sees them now. In the past, when Warren sold, few paid attention. But every time he did, something big happened. In 2008, he held steady while others crumbled. In 2020, he bought when everyone else was panicking. Today, he's doing the opposite, selling while everyone else is buying. It's not a gut feeling, it's a warning backed by facts. Because Buffett never invests blindly, never acts out of fear, but he also never ignores the signs. And what he sees now has pushed him to make drastic decisions. Is he anticipating a deep shift in the financial system? Is he seeing a loss of trust in certain sectors? Is he running from a bubble that hasn't burst yet? Maybe the answer lies in a single word: asymmetry. While small investors risk everything for instant promises, Buffett focuses on preserving what's taken generations to build. And if he's protecting himself, shouldn't you at least ask why? What truly sets Buffett apart in this historical moment is his ability to go against the grain without fear of judgment. Because he understands something fundamental. When everyone thinks the same, no one is really thinking. The crowd can be wrong, and it often has been. But those who watch with critical eyes, who don't get swept up in the hype, often come out unharmed, or even stronger. You get to choose your path, the path of noise or the path of strategic vision. The answer could make the difference between losing everything and coming out stronger from what's coming. Because what Buffett sees, and what many still refuse to see, could be the quiet crack before the big collapse. And what about you? Are you willing to look beyond the noise? Leave a comment if you've ever ignored a warning sign and regretted it later. Chapter 2. Massive sell-off in Apple and banks, a red flag. For years, Apple was the crown jewel in Warren Buffett's portfolio, not just for its financial value, but for what it represented: a leading company with constant innovation, healthy margins, and a powerhouse brand. However, what once seemed untouchable is now becoming dispensable. Buffett is selling. Not just a symbolic amount, not just a small correction, he's dismantling a major part of his position. And it's not just Apple. Bank of America, one of his favorite banks, is also being let go. Over 80% of his stake has been liquidated. It's a move that screams, even if no one wants to hear it. When an investor like Buffett makes a move, it's not to roll the dice. He doesn't react like most investors do, driven by fear or market excitement. He acts after reading every report, making every call, analyzing every chart with a magnifying glass. And if, after all that, he decides to exit companies that have historically been solid, there's a serious reason. He sees what others don't. He sees structural weaknesses the market hasn't yet absorbed. In Apple's case, the issue might be innovation fatigue, stagnating markets, and a saturated ecosystem. Selling iPhones isn't enough anymore. The digital services that fueled growth in recent years might have already peaked. With banks like Bank of America, the problem runs even deeper. Dependence on credit in a world of uncertain interest rates, regulatory risks, and an economy possibly inflated by public debt, all of it creates a silent storm Buffett would rather avoid. It's crucial to understand that selling doesn't always mean giving up. Sometimes selling is self-defense, a defensive move before the battlefield becomes impossible to cross. Buffett seems to be reading early signals, as if he knows a new financial order is being born, and the rules of the game are changing faster than most people realize. What happens if the banks, considered pillars of the system, begin to tremble? And what if tech giants, once thought invincible, become vulnerable to new regulations or changing consumer behavior? This isn't about panic, it's about clarity. What Buffett is doing is not fleeing, it's anticipating, protecting himself before the media narrative collapses and the raw truth is exposed. That the market may be stuck in a phase of collective illusion, fueled by cherry-picked data and manufactured optimism. And now, the most important question: are you paying attention to the signs, or are you choosing to keep your eyes closed until it's too late? Comment the word awakening if you're starting to see what you used to ignore.
Chapter 3: The Corporate Debt Bomb in the United States. Imagine a balloon slowly inflating. Each puff represents a corporate decision: a new loan, a bond issued, a credit line to buy back shares, another to finance unnecessary expansions. Puff after puff. Today, that balloon has become a ticking bomb. Companies in the United States, even the most profitable ones, are drowning in over $12 trillion in debt. It's a number so large it escapes common understanding. It's as if the country has mortgaged the future of its businesses to sustain an illusion of growth. Warren Buffett doesn't just see numbers, he sees consequences. And what he sees is a corporate economy built on a mountain of compounding interest while rates remain high. Many don't get it. It's not just about having debt, it's about having to pay it in a hostile environment. When interest rates were near 0%, companies could play with fire without getting burned. But now, every percentage point cuts like a blade. And if a future administration, like Trump's, decides to stimulate the economy aggressively, we could spiral into inflation that would burst what's already on the verge of exploding. Companies are becoming prisoners of their own ambition. They must generate more revenue, not to innovate, not to grow, but to pay the interest on past decisions. It's like running on an endless treadmill. You never get anywhere, but you're increasingly exhausted. Buffett knows this, and that's why he's stepping back. Because the question isn't if it will collapse, but when and how. And most importantly, who will be trapped under the financial rubble. This is not an apocalyptic prediction. It's a warning based on cycles that repeat over and over. In the years leading up to the 2008 crisis, debt was also disguised as expansion. The warning signs were there, but the noise of easy profits was louder. Today, the signals are no less clear. We've just gotten better at ignoring them. Because admitting that something as big as an economy can fall requires a kind of courage few people have. Warren Buffett isn't running away, he's gaining distance. He's climbing a hill to see the whole battlefield, while many are still trapped in the trenches, unaware that the artillery is about to strike. This isn't about being afraid. It's about having clarity and acting with awareness, not denial. Have you ever felt like the world keeps moving while you're weighed down by invisible debts? Comment the word clarity if you're ready to see what others choose not to. Chapter 4. CEOs are selling their stocks. Coincidence? Imagine you're on a luxury cruise ship. Everything seems perfect. The weather, the music, the toasts. But suddenly, the captains, one by one, start quietly leaving in private lifeboats. No noise, no explanation. They just go. What would you do? Keep dancing on deck as if nothing's happening? In the last 6 months, that's exactly what has happened inside America's biggest corporations. CEOs, founders, high-level executives, they're selling their stocks in volumes approaching historic records. These aren't just tactical moves. These are strategic exits, quiet retreats before a possible collapse. And the most unsettling part is that many are selling right when their companies are reporting profits or appearing to be at their peak. Warren Buffett doesn't need anyone shouting in his ear. He hears the silence. And when those who know the most about a company's future start selling, it's not a coincidence. It's an encrypted message only a few can decode. Something is breaking from the inside. You don't need to see flames to know the smoke smells like ashes to be. This isn't about spreading fear, it's about raising awareness. When leaders leave the table before the feast is over, perhaps they already know the main course will be hard to digest. And if they, with all the insider info, real data, and confidential analysis, are letting go of the reins, what does that say for the rest of us? Buffett has learned to spot those moments when the market's smile is just makeup, hiding exhaustion, debt, and emotional manipulation. Because yes, the stock market gets emotional too. And nothing is more dangerous than an ecstatic crowd ignoring the signals only a few dare to see. Sometimes the bravest move isn't to keep investing. It's to stop, to listen, to watch what the seasoned players are doing. The real investor isn't the one waiting for miracles, but the one who knows how to read between the lines. Have you ever seen someone walk away from something without a word, and then everything fell apart? Write it down below. Your story might open someone else's eyes.
Chapter 5. The S&P 500 Index and the P/E ratio. Dangers lurking ahead. There's a language not everyone understands, yet it speaks louder than any speech. The language of numbers. And there's one number in particular that's screaming right now, though very few are taking the time to listen. The P/E ratio, price to earnings, of the S&P 500 is flirting with historically dangerous levels. In simple terms, people are paying far too much for the current earnings of companies. When was the last time this happened? Right before the dot-com bubble burst and shortly before the 2008 collapse. It's as if the market is walking along the edge of a cliff blindfolded and smiling. Warren Buffett has always been a lover of cycles. He knows that everything that rises too high eventually falls. And now he watches this ratio the way someone watches an hourglass. The sand isn't just falling anymore, it's crashing down. For him, it's not a question of if a correction will come, but when. Numbers don't lie, but they do warn. The problem is that we often choose to ignore them, like someone avoiding opening a doctor's report out of fear of the diagnosis. But the diagnosis is there, and this time it takes the shape of a ratio inflated by euphoria, by outlandish expectations, by blind faith that the good times will never end. But history is a subtle poet. It never repeats the same verse word for word, but it always rhymes. And right now, the rhymes sound eerily similar to those that came before the greatest crashes of the century. You don't need to be a fortune teller to anticipate it. You just need to pay attention. When the real value of things disconnects from what people are willing to pay for them, the market becomes a theater of illusions. And when the curtain falls, applause turns into silence.
Are you willing to wait until the curtain drops, or would you rather leave before the music stops? Have you ever felt like everything was about to break, but no one else saw it coming? Tell me your story. Your intuition is also a form of wisdom. Chapter 6: Trump's Policies and the Shift in the Rules of the Game. When Donald Trump announced his return to the political stage, the market reacted like an excited child seeing their old superhero come back. The stock exchanges perked up, business leaders toasted, and headlines were filled with promises of growth. But amidst all that ovation, Warren Buffett quietly stepped away. Many interpreted his move as pessimism, but Buffett doesn't act on emotions, he acts on deep readings of the global board. And what he saw, few dared to notice: a new game, with new rules, and with too many hidden risks. The proposed 60% tariffs on products from China, Mexico, and Canada weren't just economic measures, they were earthquakes. Silent at first, but capable of cracking even the most solid foundations of the global economy. To understand it, imagine a company as a Swiss watch. Every gear, factories, suppliers, transportation, markets has been precisely calibrated. Suddenly, one piece changes size, or disappears, or becomes unreachable. That's what these new policies generate: a forced reprogramming of production systems, a brutal disruption of industrial harmony. And those dissonances don't just mean higher costs, they mean uncertainty. They mean companies that, overnight, are forced to improvise. And what does Buffett do when the horizon turns foggy? He turns around. He gets off the train before the tracks change direction. It's easy to be seduced by collective euphoria, but euphoria is a terrible advisor. It makes us focus on the immediate and forget the essential. It makes us believe that the roar of the present will last forever. And yet, history always ends by whispering something different. Trump may be moving pieces with force, but Buffett is reading the whole board. And his move is clear: step out of the game when the rules stop making sense. Have you ever felt that everyone was going one way and you just knew the path was different? Tell me below. Sometimes intuition is more powerful than any statistic. Chapter 7: Tax Cuts and the Fiscal Deficit. At first glance, tax cuts sound like a blessing. More money in your pocket, less pressure on businesses, accelerated growth. But underneath, like a river that seems calm on the surface, there are dangerous currents that only a few know how to spot. Trump, true to his disruptive style, pushed a series of tax cuts that lit up Wall Street with excitement. But while the market celebrated, the national debt crossed an invisible threshold, over $35 trillion. And then comes the question very few dare to ask: what happens when a country can no longer pay its debt? The answer is uncomfortable but inevitable. There are only two paths. Either taxes are raised later, painfully, quickly, and massively, or inflation is allowed to do the dirty work, erode the value of money, raise the cost of everything, and slowly impoverish those without financial protection. Both paths ultimately threaten the most sacred thing you have: your ability to live in peace. Warren Buffett doesn't ignore these scenarios. That's why he doesn't invest in just any company. He picks those with what he calls pricing power, the ability to raise prices. What does this mean? That if everything else becomes more expensive, they can raise their prices too, without losing customers. Like Coca-Cola, like Apple, like those major brands that don't sell products, they sell emotions, habits, identity. Buffett doesn't bet on what shines today. He bets on what can weather the storm tomorrow, because he knows cycles are relentless, that today's party is tomorrow's reckoning, and that in that transition, only those who understand the hidden rules of the economic game survive. The economy is like a building. It might look solid, but if the foundation is cracked, everything can collapse. And the fiscal deficit is a crack that grows silently until it can no longer be ignored. Have you ever felt like everything looked fine until suddenly it didn't? Tell me in the comments. The deepest truths often come from those doubts few dare to speak out loud. Chapter 8. Deregulation, a double-edged sword? When barriers are removed, the road seems freer, but also more dangerous. In his quest to energize the economy, Trump dismantled hundreds of regulations. Entire sectors cheered. Fewer rules, fewer limits, more short-term profits. But like anything that shines too quickly, that light can be the start of combustion. Warren Buffett has seen this cycle before. He's lived it, and he remembers. Every wave of deregulation is followed by a tide of unintended consequences. When companies operate without oversight, many push the limits. And when that happens, the regulatory pendulum doesn't just swing back. It comes back with fury, with penalties, with new rules as harsh as the damage they aim to correct. Economic history is full of examples. The 2008 financial crisis wasn't just about greed. It was about a lack of boundaries, misunderstood deregulation, and the price was paid by millions of people who didn't even know how those systems worked. Because when the system collapses, it doesn't discriminate. It drags everyone down. Buffett doesn't invest in what's profitable today if it puts tomorrow's stability at risk. He's not interested in instant gains if systemic danger lurks. He prefers strong companies with structures capable of weathering regulatory storms. Because he knows the market doesn't forgive naivety, and neither does politics. There's something most people don't realize. Regulations exist because someone once abused the system. And when they're removed entirely, that cycle begins again. The game becomes dangerous. And Buffett, a veteran player, knows when it's no longer worth sitting at the table. Have you ever felt like something that was too good to be true turned out to be exactly that? Leave it in the comments. Sometimes our greatest lessons come from those invisible hits we never saw coming. Chapter 9. Buffett's Response: Cash and Bonds. In a world where everyone's running, where speed is mistaken for intelligence and noise for wisdom, Buffett chooses silence. He chooses stillness, and he builds up cash. Not because he's afraid, but because he understands. He understands that in uncertain times, patience is the investment with the highest return. While the market plays Russian roulette with volatile stocks, he sits quietly with his suitcase full of cash and treasury bonds. They're humble, sure, not very exciting, but they offer the most precious thing when everything shakes: safety. A yield close to 5% in these instruments may not feel like a party, but it is a refuge. And in the middle of a storm, the only thing that matters is not sinking. Buffett doesn't buy promises. He buys reality. He isn't dazzled by fleeting trends. He seeks consistency, logic, protection. Because for him, the goal isn't to win faster, it's to stay in the game. To not lose the ability to bet again when the winds shift. This move, hoarding cash, buying bonds, is his way of saying, I don't need to run, I need to endure. And that quiet sentence might carry more power than all the market screams combined. Maybe in our personal lives we should ask ourselves the same. Are we chasing quick wins or building a foundation that lasts? Are we betting on what shines today or planting seeds for what will bloom tomorrow? Comment the word anchor if you've ever chosen stability over chaos. Sometimes staying grounded is the bravest thing we can do.
Chapter 10. Buffett's Greatest Secret: Concentration. In a world obsessed with having it all, a little of this, a bit of that, Buffett chose a different path: the path of focus. The path of looking deep instead of looking wide, of whispering to a few companies rather than shouting at hundreds. Over 60% of his portfolio is concentrated in just 5 companies. To most people, that sounds insane, risky, reckless. But Buffett doesn't think like most people. He doesn't invest like someone flipping coins, hoping for luck.
He invests like someone who knows the soul of a business, like someone who looks a company in the eye and says, "I'm with you all the way." Because to him, investing isn't about diversifying out of fear. It's about concentrating out of conviction. It's not about scattering seeds everywhere hoping something grows. It's about carefully choosing the soil, planting with intention, and staying long enough to watch the tree grow without rushing. Behind that seemingly rigid approach lies a powerful lesson. True strength comes from choosing a few things and loving them deeply. Knowing them, understanding them, standing by them. Whether it's a stock, a cause, a person, or a purpose. In a world that praises those who juggle 10 things at once, Buffett reminds us of the value of holding just one and never letting go. Comment the word focus if you've ever chosen to concentrate on what really matters. Because sometimes everything changes when you stop looking everywhere and start looking closely. Protecting your money isn't just for the wealthy, it's a personal responsibility. If you educate yourself, act strategically, and think long-term, your future will change. As Buffett says, risk comes not from investing, but from not knowing what you're doing. So wake up, take action, and declare that today is the start of your financial freedom.